Imagine if every time someone ordered a package online or bought a new smartphone, a few pennies went straight into your pocket. To understand how everyday people set up that exact income stream, imagine a neighborhood pizza shop. It is a highly successful, profitable local business, and the whole operation is worth exactly $100. This graphic represents the business as a pizza. Let's say the owner wants to build a second location, but needs cash to do it. They cut the business into 10 equal slices and sell them to the public for $10 each. If you buy one slice, you own 10% of the company. In the financial world, that ownership slice is called a share. Now, keep your eyes on that single slice. If the pizza shop opens its new location and doubles its customer base, the entire company becomes more valuable. Your $10 slice might now be worth $15. You can sell it to a new buyer and pocket the $5 difference. Investors call this a capital gain, or you can take a different route. Notice this steady flow of coins moving toward your slice. Some successful companies choose to share their cash register profits directly with the people who own the slices, sending you a regular cut of the money just for holding on to your stock. These regular cash payments are called dividends. The stock market operates on this exact same logic. When you buy a stock, you are buying a digital slice of a real, functioning business. It is simply scaled up to represent massive global corporations instead of a single neighborhood shop. So, how do you actually buy one of these corporate slices? You cannot exactly knock on a chief executive's door and hand them a $20 bill. Instead, you go to a stock exchange. Think of an exchange as a highly regulated supermarket where the only items on the shelves are shares of different businesses. The most famous supermarket of them all is the New York Stock Exchange. With its heavy stone pillars and long history, it is the largest global hub for trading, usually home to massive established brands like Coca-Cola or JP Morgan. Then you have the NASDAQ. This is a digital-first exchange, known primarily as the home for heavy-hitting technology companies like Apple and Microsoft. This flowchart tracks how a digital trade actually happens. When you tap Buy on a brokerage app on your phone, the app instantly routes your order to an exchange server. The server matches you with someone willing to sell at your price and transfers the ownership to you in a fraction of a second. The stock market is a hyper-fast, rigidly organized matching engine designed to connect buyers with sellers securely and efficiently. If a business is doing well, you might wonder why its stock price constantly flickers up and down all day long. This animated scale illustrates the foundational rule of supply and demand. When more people want to buy a stock than sell it, the buyer side gets heavy, and the price gets pushed up. When more people want to sell, the price falls. Looking at the scale again, you can see real-world metrics tipping the balance. If a company announces strong profits, or if low interest rates make it cheap for businesses to borrow money, investors feel confident. They rush to the buyer side to get a slice, pushing the price higher. But human psychology also plays a massive role. Fear over a bad news headline or greed from a viral trend can cause sudden, unpredictable waves of buying or selling, moving the price even if the underlying business has not changed at all. Those price swings might look chaotic, but they are real-time global scorecards. They measure the exact level of human confidence in a company's ability to grow. At this point, you might be feeling a little stressed. With thousands of public companies out there, how do you pick the one perfect pizza shop that will succeed, while avoiding the ones that will lose your money? The short answer is, you do not have to pick just one. You can use a financial cheat code for beginners called an index fund, specifically one tracking the S&P 500. This diagram shows how an exchange-traded fund, or ETF, works. Instead of buying one massive slice of a single company, buying one share of an S&P 500 ETF gives you a tiny microcrumb of the 500 largest businesses in America, all packaged together into one purchase. By holding a piece of so many companies at once, you get instant diversification. You turn investing from a high-stakes gamble on one chief executive's decisions into a reliable, long-term bet on the continuous growth of the entire economy. To get started safely, build up an emergency cash savings fund first. This ensures you will never be forced to sell your stocks in a panic just to pay your rent. Then, take 15 minutes to open an account with a zero-fee brokerage app. Once you are set up, start practicing a strategy called dollar cost averaging. This means automatically investing a flat, set amount of money every single month, totally ignoring whether the daily financial news is good or bad. This line graph tracks the market's long-term growth, showing periods of rising prices, called a bull market, and falling prices, called a bear market. Notice how those bear market dips are marked here. When prices fall, your flat monthly investment automatically buys more shares on sale. History shows us a clear pattern. Investors who keep adding money and stay in the market through those downturns consistently recover and build long-term wealth. The stock market is simply a digital pathway to owning a real piece of global commerce. If you found this helpful, hit the subscribe button and let me know your biggest question about investing down in the comments.